Good morning. This is Larry McMillan with a stock market comment on Monday, August 30th, before the market opens. So we had another strong week last week with S&P closing at a new all-time high, and it did so with some strong breadth. So that's an improvement in an area that had been faltering previously. So the support on S&P is at 4370, and as long as we remain above that, the chart is positive, and you should be retaining a long core position. There are some worries. Of course, there's always some worries, but right now that S&P chart is the main bullish indicator. The other indices, QQQ is keeping pace, and the Russell 2000 is actually trying to pick up its lagging pace. And so we have been in our newsletters and things buying some IWM calls as well. The equity-only put-call ratios are on sell signals. I would say they're wavering sell signals because the ratios have really kind of been moving sideways for a couple of weeks. But the computer analysis programs that we use to analyze those charts continues to say that they're still on sell signals. So it has a good track record, the computer analysis, so we will stick with that. Breadth has improved a lot, and I mentioned on Friday, with S&P making a new all-time high, it was also a 90% up day in terms of stocks only day. In other words, stocks only is for us optionable stocks, and in optionable stocks, 90% of them were advancing while only 10% were declining, so that's a 90% up day. And I really couldn't find another up day this century where a 90% up day coincided with a new all-time high in SPX. Usually they're coming off a heavy sell signal at a bottom, not so much confirming a top, but that does seem like a strong indicator to me. Meanwhile, our breadth oscillators are on buy signals. They're only in modestly overbought territory. We'd really like to see them get more deeply into overbought territory to match the strength of SPX, but for right now, stocks are still not matching the strength of SPX. The average stock is not. In any case, those are on buy signals. Cumulative breadth continues to lag behind, and so that is the main negative divergence in this market. It's still in place, and so that dictates that one should remain on alert, raise your trailing stops as stocks go higher, and then, most importantly, adhere to those stops if they get hit. New highs have taken the lead over new lows again. That's 52-week highs, 52-week lows on all data sets, New York Stock Exchange, stocks only, and NASDAQ. So that's a positive indicator. It's perhaps not as positive as we'd like to see, but still new highs are outnumbering new lows. So that's a bullish indicator for now. VIX is much more bullish. The VIX deals with SPX options, of course, and so things that are dealing with SPX have a much more bullish look than things dealing with the broad market of stocks. So in VIX, we have the spike peak buy signal of, I believe, August 19th is still in effect, and the trend of VIX is lower. That's bullish for stocks as well. And finally, the construct of volatility derivatives, the futures, VIX futures are in a positive state for stocks as well. The term structure slopes upwards, and the futures are trading at a premium to VIX. So all of these things are positive pretty much, except for the equity-only put-call ratios. There are a couple of other minor negative things. Realized volatility is quite low. There is a McMillan volatility band sell signal in place on the S&P, but until or unless 4370 is broken as support for SPX, this is still a bull market. So have a great pre-holiday week trading, and visit our website. We'll take a look at some of our letters and things where we track all these indicators daily.